welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer and independent advisories. We also have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, founder of the internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. Finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, please check out our people section at www.nucleuswealth.com. Our presenters today include myself, Tim Fuller, a certified financial advisor who's worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer and independent advisories. Sitting across from me, we have David Llewellyn-Smith, co-author of The Great Crash of 2008 with Ross Garnaut, also the founder of internationally acclaimed Diplomat magazine, and now chief editor of the enormously popular Macro Business Financial blog. We also have Leith Van Onselen, our resident Nucleus Wealth economist, who has spent time with both the federal and Victorian treasuries, along with some time as an analyst with Goldman Sachs. Leith now co-authors the widely read Macro Business Financial blog with David Llewellyn-Smith. And finally, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy and big data in the $60 billion global quantitative equity fund at Schroders, who are a multinational asset management company. And for more information, of course, please check out our people section at www.nucleuswealth.com. Yes, so hello and welcome to our next instalment of Nucleus Insights, and today's one is entitled OzEconomics. I've been really looking forward to this one, and in fact we've got in a special guest, a rare view of of an economist out in the wild in Leith Van Onselen, who is of course Nucleus Wealth's chief economic advisor, economic strategist. So welcome to you, Leith. And just a quick note as well that our regular mainstay and dulcet toned member of our audience in David Llewellyn-Smith has unfortunately called in sick just moments ago. So we will, if you're looking forward to him, don't worry, he'll be coming up in one of our later instalments. On with the show. So the agenda today, we're going to be looking at quite a broad cross-section of the Australian economy. So strap in. We are going quite in depth. We've got a pretty sizable amount of charts to run through today. We've tried to trim them back, but there's so much info out there, and there's so much good insight to be had that it was quite a difficult task. But we are going to initially look at the gross domestic product trends of Australia, national demand and how that's reflecting in corporate profits. A little bit of a look at our national savings ratio, and then we're going to move into some more common topics. And if you're a macro business blog reader, of course, you'll know these quite well, but looking at the upcoming and currently in place infrastructure boom, the population surge, a bit of a reflection on how this is impacting Australian housing and where we think it's going to go. And then finishing up with, of course, impacts on investments in the equity markets that, of course, we do every day here at Nucleus Wealth. So with no further ado, I'll hand over to Leith and we can kick off with our GDP trends. Welcome, Leith.
Yeah, thanks, Tim. Thanks for having me, and hello to everyone. Look, as Tim said, we just want to go through a few of the main sort of charts and trends affecting the Australian economy, which provides some insight into where we're at and hopefully where we're headed. The first chart on the left is obviously Australia's GDP growth going back to the last recession back in the early 90s. And what it shows pretty clearly is that Australia's GDP growth has been trending down for the better part of a quarter of a century, both in aggregate, so the headline GDP, as well as even more so in per capita terms. So in the year just gone to December 2017, Australia's GDP grew by about 2.4% year on year, and only 0.4% in per capita terms. So it is very weak. And if we just focus in on just GDP per capita, the quarterly rate of growth, you can see that it has fallen very significantly over the past quarter century. And we have actually had 2 per capita recessions in that time, as well as 2 very near misses, where we had 2 consecutive quarters of 0% growth. So the aggregate economy is travelling, okay, if you measure it on an aggregate basis, but the per person lived experience has actually been getting worse with falling growth for at least well over a decade.
Okay, sure, and we'll look at some of the reasons why the GDP is up and the per capita is down, perhaps in a few slides later on in the show. So, okay, any other further notes on that one there, Leith?
Yeah, no, not on GDP.
Okay, sure. So let's have a look at national demand now. We'll swing around to what appears to be some signs of life. Perhaps, looking from 2013, there was a pretty reasonable fall, and then over time there seems to be a bit of a period of consolidation, and then it looking, for all purposes, reasonably healthy. What are your thoughts?
Yeah, look, it definitely has rebounded. Now, national demand or domestic final demand is actually a bit different to GDP because it doesn't include net exports. But
okay.
So it's basically just the spending across the economy. So it's probably actually a better measure of what you're actually feeling. And it has certainly picked up to about 3% in the year to December. So it has improved. And a lot of that is on the back of 3 things. Really, the big drag from the mining investment boom in business investment has disappeared. At the same time, we've had quite a lot of support from public investment, so that's public infrastructure and etc. And household final consumption expenditures actually held up pretty well, which is actually the biggest component of GDP. It's about 56%. However, if you go to the next slide, again in per capita terms, it's been travelling very poorly. So this chart actually shows a few different measures, but in there's the domestic final demand per capita. And as you can see, there's actually been 0 growth for about 5 years, although even though it has picked up more recently. So again, it's this situation where, at an aggregate level, we've been doing okay, but in a per capita sense, we've really been going nowhere. And the next... Can
I jump in there as well?
Damien. Yep.
Yeah, jump in there as well, Leith. So there were some very big projects that are just sort of starting to come in now, and I guess one like the Gorgon project and is probably there's the Wheatstone and a whole bunch of them. So yeah, all the LNG plays, and they're all a significant proportion of GDP as a percentage. So Gorgon was, I think, 5% of Aussie GDP spread over a number of years, obviously. Now, as that flips from spending money on Australian workers and into actually earning money, is that sort of overstating? My take is that's probably overstating GDP a little bit in that Chevron owns it. The money sort of looks like it's coming in from a gross domestic income perspective in that we've sold the oil, but the profits are all flowing straight back out to Chevron. So it's sort of just a transfer effectively. And it's not really, so it's sort of like it's making, it's washing through, and it's making income look higher than it really is because it's in one side and out the other. Is that right?
Yeah, definitely. The infrastructure, the mining projects are predominantly foreign owned. So there's about at least 80% foreign owned. So a lot of the profits that flow from that end up flowing offshore. And there's no doubt that the biggest impact from these projects was during the construction phase. So during the peak of mining construction, the capex, mining capex was about 9% of GDP, which is absolutely massive. And that, of course, is very employment heavy. So according to RBA research, at the peak of the mining boom, the mining sector was employing about 10% of the economy.
Wow.
That's about 3%, I think, in extraction at peak, and the rest of it was all in mining construction. So obviously now those construction projects that come online, it doesn't actually require a lot of people, and it also doesn't require a lot of wages to be paid. And a lot of these miners are becoming increasingly automated as well. So look, it probably does overstate GDP, and that could be another reason why the GDP per capita has been tracking better than actual domestic demand. And this actually is a beautiful segue into the next slide, which shows the impact on the share of the economy, I guess, profits versus wages. So as the chart shows that business profits have actually risen quite significantly over the past 2 years. Part of that's due to the huge commodity price spike, whereas actual wages and salaries have basically flatlined, and they've actually gone backwards. If you go to the next slide, they've actually fallen by about 4% over the past 6 years, at the same time as labour productivity has increased. So effectively, we've had this rotation where company profits, where businesses have gained the lion's share of the benefit of the national income increase, whereas actual wages and salaries, i.e. workers, have gone backwards. And again, this is a great segue into the next slide. You might note from that domestic demand chart earlier that one of the big supports to domestic demand has actually been household consumption, which accounts for about 56% of that. So it's actually the biggest share. As households' wages have been going backwards, they've actually been drawing down their savings in order to maintain the same level of consumption, which is obviously not sustainable. So the household saving rate's fallen to about the lowest level since the global financial crisis, and has been falling very steadily over the past several years. At the same time, Australia's household debt has spiralled to the highest level on record. So we're in this situation where household consumption has been travelling okay, but again, it's not sustainable. In the face of falling wages, you can't maintain consumption levels unless you basically binge on debt and draw down your savings, and that's exactly what the Australian economy has done.
So essentially, it's got to come from somewhere, and if wages aren't rising and productivity is rising and companies are making more money and they're not passing that through, then people turn to the home equity loans perhaps, and obviously this increasing debt in general.
Yeah, that's right.
Yeah.
Actually, have you seen any stats on that, just in terms of the part where you go, look, my house has just increased by $200,000, and so I better put a $200,000 extension on my house to, I'll draw down the money I've got and spend that to doing something. Have you seen any? And I guess the thought I've got is that, as house prices have rolled over now and starting to drift downwards, is whether that's starting to slow up yet, or what the thoughts are within that.
Look, the Reserve Bank of Australia does release periodically, hasn't done one for several years, but does release a home equity withdrawal data. It comes out in speeches every couple of years, they put it in there, and what it showed is in the run-up to the GFC, the households were borrowing like crazy, and then when the GFC hit and the housing market paused or fell a little bit temporarily, home equity withdrawal, then households began to save. And then I think the last one, which was a couple of years ago, showed that they were starting to borrow again. So my expectation is that once, given we've got falling house prices now, there will be a time, it might take another 6 months to actually show in the data. But once households realise that their biggest asset's fallen in value, or at least not likely to increase, you're likely to get them increasing their savings rate and then also reducing consumption. So that is one of the headwinds that's facing the Australian economy.
Okay, very good. Thanks, Leith and Damien. So we'll jump across now to one of our focuses on one of our mini booms, I guess, and this one, the infrastructure boom, is pretty relevant to those, particularly those who are living in Melbourne and Sydney, with the amount of roadworks and closed roads and everything else. So what have you got to tell us here?
Yeah, this is a chart that comes from ANZ. I think it's updated annually. It's probably about 6 months old, but it's fairly telling. what it shows is that Australia is going through an infrastructure boom, which we all know. If you live in Sydney and Melbourne, you see it. And a lot of this is government funded, or at least government supported. And last year, the growth was supported to a huge extent by infrastructure spending by governments, and that was shown in that chart earlier, public investment. However, we've got about probably 18 more months of that to run before it peaks. And the increases this year and then next year are actually smaller than they were last year. So the stimulus to growth is going to be less and less, and then it'll eventually turn around, a bit like the mining investment boom did, where it starts actually subtracting from growth and jobs. But at the moment, that is one of the supports, and again, that was why that earlier chart on final demand showed government spending being such a big support.
And so just quickly on the infrastructure there as well, you can see it sort of looking like it's tapering in 2020. Is that obviously a 6-month-old information, but is there a chance that the infrastructure boom will just build on and on and on, or is there some sort of a ceiling or a limiting factor that might if they update it in 6 months' time, could continue that downward trend as opposed to stacking more on? Could it be a change in government or a increasing more infrastructure? I can't see how we could jam any more construction vehicles into Melbourne at the moment.
Yeah, look, it's hard to say. I mean, they could always do more projects, but in the end, it's got to be paid for somehow. And I think a lot of the governments are perhaps might be getting to their limits on that. Look, I really don't know, but at the moment, that's how it stands. It does. The pipeline looks like it will peak and then fall. Whether it might get a second run, I'm not sure at this stage. There hasn't been any evidence of that, but it certainly could come.
Okay, sure.
I'll basically just be guessing.
No problems. Damien?
Yep. Yeah, in terms of when the financial crisis hit, we had this whole thing that we should have a bunch of shovel-ready projects that are all ready to go, so that if something happens and let's say a trade war breaks out or whatever it is, and we get a bit of an economic downturn globally, and Australia really cops the brunt of it. Do we really actually have these shovel-ready projects? Are they ready to go, or is that just that's a list of things we should have done but never actually got around to?
No, for next time.
Yeah, look, it is a problem with infrastructure more generally. The Infrastructure Australia does have a list of priority projects, and but none of them are really shovel-ready because there's a huge lead time required with these projects. So if the proverbial does hit the fan, it's that the government, sure, they could go and try and increase infrastructure spending, but it probably won't hit for at least 12 months. And then by that stage, the crisis might have, I wouldn't say necessarily be over, but yeah, we've already copped the worst of it, and there is the chance that then you're stimulating when the uptick already comes, so it ends up becoming sort of pro-cyclical. That's why during the GFC we instead saw cash handed out in bribes, which is, I guess, a better way to stimulate in the short term, but it doesn't give you a long-term payoff. So. Yeah, I think if another GFC hits, we're probably more likely to see that kind of thing, a cash splash that gives you no long-term benefit and just worsens the deficit, but at least buys you some time in the short term.
Okay, sure. And then moving, I guess, to the net effect of all this infrastructure spending, of course, being the change in jobs. And you hear bandied around, the current government's responsible for creating 1,000 jobs a day, which is it's a lovely stat. But what can you tell us about the changes in jobs thus far?
Yeah, look at the government a few months ago, or probably 3-4 months ago, was boasting 1,000 jobs a day, and actually the Australian economy is travelling a bit better than that. We added 400,000 jobs in the year to January, so that was a pretty good result, and a lot of those are actually full time in the last year. So. On the face of it, it is looking pretty good, and the infrastructure boom is certainly helping with that. There is one problem, and that comes with the next chart, is that Australia's population also grew by 400,000. So it's basically a rat wheel economy at the moment, where we're spinning the tyres and not really going anywhere. And of course, this was on the back of mass immigration, which is running at incredibly high levels, particularly into Sydney and Melbourne. So effectively, we added 400,000 jobs, but population increased by 400,000. So
net.
Yeah. Net. It's not that great a story, and this is showing up in the next chart, which is the labour underutilisation rate. Now, what this measures, it's probably the best measure of slack in the labour market. It measures both unemployment and underemployment combined, and this shows that labour underutilisation in Australia is still tracking at just under 14%, and it's at very high levels. And this is actually probably the best measure to gauge wages growth against. I don't actually have the chart on me, but it does track that when labour underutilisation is high, you get low wages growth, and when it's low, you get high wages growth.
And it certainly is quite elevated at the moment.
So can you just jump into how that's calculated, that rate?
Yeah, so it's the underemployment rate, so people who would like more hours, combined with the unemployment rate. So you just add one to the other.
Okay.
So yeah, underemployment's tracking near all-time highs, but unemployment's not. But combined, it's close to 14%.
Okay.
And is this closer then to the Roy Morgan? Obviously, does their one where they ask people, "Are you unemployed?" and they get much higher rates than the official stats. Is this one pretty close to the Roy Morgan, or much closer? Do you think?
Yeah, it's definitely closer. The Roy Morgan one might actually measure unemployed people that the ABS excludes altogether, because the ABS you got to be actively looking for a job, and you have to have at least worked an hour or something like that. It's pretty useless, but it is a globally recognised norm, so that's why we use it. Whereas Roy Morgan will still count you as unemployed if you'd like a job, but you're not actually looking for a job because you're discouraged. There is a bit of a difference, but it's certainly closer to Roy Morgan's.
Okay, sure. And just while we're on the topic of employment, we've got a little bit of we've got a fantastic graph there. I think it's quite telling of an annual change in jobs for last year, essentially, broken down into sectors. Obviously, it's I guess it's quite telling in the sense that you can run through the tail end of the sectors there, but there is a couple of overall themes I can see from the Leith.
Yeah, I absolutely love this data release. It comes out every quarter. It was released last week, the latest one, and it's current up to February. And what it shows is that the top 4 job creators in the past year are government related or population Ponzi related. So, as you can see, the biggest one there by far is healthcare and social assistance, and then you've also got construction, retail, and education, etc. The healthcare and social assistance has gotten a big kick along from the NDIS, which according to some estimates has added about 100,000 jobs in the past year. So and in fact the trends are even stronger if you look at it from since the global financial crisis in September 2008. And what that shows is again a similar trend, but as you can see, healthcare and social assistance has added about 600,000 jobs. So these are the so-called caring jobs you read about. We've got a caring jobs boom, people in old people's homes, hospitals, social workers, etc. Now, there is a bit of a problem with this. My colleague David Llewellyn-Smith, who you all know, coined the phrase. He's very good at turn of phrase, and he coined the phrase Botox boom. So, which is basically a profitless boom that shifts money around the economy rather than actually creating wealth. And that's basically what we've seen with employment and as well as with GDP. Basically, we've got a government-stimulated economy in both jobs and growth, as well as obviously a population Ponzi stimulated economy. And the problem with these is they're all low productivity sectors. They're not actually creating new wealth. They're just basically paid for through taxation and shifting money around. So it is a bit of a long-term worry, in my view, that we don't have more productive drivers for the economy.
Okay, sure. And Damien?
How much longer has the NDIS got to go? So the rollout's, I think, sort of finishing up this year, and then I guess you sort of, I'm assuming there's a bit of a lagged effect of people getting the money and doing, so there's probably, 2 more years maybe of sort of growth, I guess, in that sector?
Yeah, I read an estimate recently. They reckon there's another 150,000 jobs to be created from it, and it is actually running behind schedule. And I can attest to this. I've got an autistic child, and we're currently being run through the NDIS, and it's been delayed by about 6 months. So, and the amount of red tape as well as middlemen and etc. you have to deal with is quite unbelievable. So it is creating a lot of jobs, but if you excuse my French, they're probably the epitome of the so-called bullshit jobs. Which a lot of them don't actually need to be created, and they're really just middlemen. So it's not it's basically a extractor job, which extracts wealth.
Well, it's essentially a service level job that's
paid for through taxation.
It's paid for through taxation, Lisa.
Yeah,
sure.
And the concern always is, as you said, it's a bit like the education sector where we had this big, this shift out of TAFEs and sort of was going to stop paying for taxes and getting the government to provide these services, and we're going to start kind of providing it to private sector people who, with a profit motive, then extract
a profit margin, which just obviously naturally lifts the cost of everything, doesn't it?
Yeah, and manage to extract those types of chains, and then and so I guess that's sort of my fear as well is. It's a positive for companies involved in that sector, but there's obviously there's a person who needs some help, and there's a person who can give them help, and that's a good transaction. But if you end up with 6 middlemen sitting in between, all giving advice on this or giving advice on that, is where the economy obviously loses out, and it might look good from a GDP perspective, but the net effect on productivity is very low.
You raised a couple of interesting things there, Damien. I think one is that I guess this sort of semi-cyclical nature that we might be facing with the NDIS. Eventually it'll cap out as full allocation of jobs, and we'll see that fall back. But the other one is just looking more from an equity and investment standpoint, and there's been obviously a pretty big push into healthcare. We've seen some stars and some not so great equity holdings in the ASX. But do you think this is a direct correlation into this? So is the NDIS a pool of money that's now potentially creating a boom in the healthcare, or is this something that's on your radar, or is it something that we don't need to worry about?
Look, it's certainly something we consider. The healthcare sector we'd like to get more exposure to. The problem in the healthcare sector is it's so expensive, and it's in particular some of the big names in it are just 30 times earnings type expensive. So it's getting the right exposure is very difficult. I think there's a certain element, and that's where sort of my questions are leading with in terms of this, is that yes, I think there are some benefits, and there's probably some of the diagnostic type of ones that where running not useless, but low value diagnostic tests when you have to pay for it yourself are less likely to be done. Okay. When you have money which has to be earmarked for some sort of medical procedure, and you have a medical procedure that someone's offering you that
fits the bill.
That fits the bill. Yeah, I've got to spend it on something. It may as well be that service you've offered me. So I think there's certainly that that for a lot of the local sort of either diagnostics or hospitals and things like that. I do suspect there's probably a bigger boom in some of the some of the therapies and things like that. Whether it be speech or OT and those types of things, and those ones do tend to be smaller businesses as opposed to large multinational organizations. Yep. And so I think that's probably there's benefits, but I think the benefits is probably more in the employment side and flowing to smaller businesses than as much in the larger businesses in the
investable space that we deal in.
Yeah, I mean, having said that, there is some benefits, but it's just not a lot of the benefits is ending up in other sectors of that economy.
Okay, no, look, that's fascinating. Anything final on the population surge, Leith, or shall we jump into one of the mainstays of Aussie housing?
I'm sure everyone's sick of hearing me talk about it, or at least write about it, so we probably should move on.
Okay, not a problem, but you can check it out on the blog for more details.
Every day.
So, of course, we move into one of our, I guess, almost essentially a super topic, because it is, one of the core parts of Australian life, really, having and owning a house and having somewhere to live. And I thought we might start with this graph. It is an interesting one in the sense that we've got a little bit of a potential convergence going on here in the way that data's growing. Do you want to just elaborate on this a little bit there, Leith?
Yeah. So for several years, Australia's population grew well ahead of dwelling construction, which was well talked about, the housing shortage, etc. And then over the past couple of years, as population tapered down a little bit, dwelling construction picked up, and now we've got it going the other way again, whereby population growth is picking up just as dwelling construction is falling. So, Australia has had a huge dwelling construction boom over the past couple of years. We had record dwelling construction levels, but we have now turned a corner, and dwelling construction has now started to turn. It's shown pretty clearly in that chart with approvals, completions, and commencements. But the next chart actually comes from is a National Accounts release, and that shows the actual annual value of residential building construction. You can see there was a huge pickup, a big ramp up. In the past few quarters, it started to fall. And again, I'll point you back to that domestic final demand chart that we showed earlier. Residential building construction was adding to growth for a couple of years, and now it's just started to subtract from growth, but only just. and we expect this to continue for several years as the epic construction boom unwinds, albeit slowly.
And the question I've got is whether there's the population though puts a floor under this. So absent a change in policy, which is obviously being bounced around at the moment, but let's say we did get a Labor government and the Labor government stuck with a high immigration rate, is that to me that sort of puts a bit of a floor under how far that construction can fall, because literally because of the demand side. What your thoughts are on that?
Yeah, I agree. Definitely. I certainly don't see a construction crash with residential building, but I think it's just going to be a sort of general slow tapering down for a couple of years, and then who knows what happens. But yeah, Damien's 100% correct. As long as we're running huge immigration programs, it's going to be basically never any demand for new dwelling construction. At the same time, the Labor Party has promised in their negative gearing package, which they've promised to bring in if they get elected, to shift negative gearing incentives towards new builds. So that should also add a little bit of stimulus to new home construction. But I think as it stands, and this is also from the Housing Industry Association, pretty much everyone's expecting dwelling construction to sort of peter down over the next few years. Probably next 3 years, we're going to have falling dwelling construction, but certainly it'll still stay at pretty high levels compared to historical experience.
Okay, sure. Very good. And so we'll jump across now to a graph. This is another one of your very telling graphs, Leith, on some of the very cyclical nature of some of our major cities and the price growth year on year. What can you tell us here, mate?
Yeah, well, this is CoreLogic's data for the five major cities, and what it shows is that all the major markets, bar one, are now actually falling in value on a quarterly basis. In fact, at the five city levels, that's all the five major capitals, dwelling prices have fallen for 6 consecutive months, down a cumulative 1.6%. So it's we're not talking big falls here. We're talking about 0.25% a month, and this has been driven by Sydney, where prices have fallen by just over 4% over 7 months. So the housing cycle certainly has turned. The next chart shows the same data except on an annual basis, so year-on-year growth. And again, pretty much all markets are trending down, except Perth, but that's still stuck in negative. And so we are looking at a sort of wall-to-wall weakening, but especially driven by Sydney. And this is quite interesting because, again, it comes despite the fact that population growth is running at huge levels, particularly into New South Wales and Victoria. And also comes despite first home buyer incentives introduced on 1 July last year by the New South Wales and Victorian governments, which are helping to boost first home buyer demand, but it's not offsetting investor demand, which is shown in this next chart of housing finance growth. You can see there that overall housing finance growth has gotten weaker, but this has been driven exclusively by investor finance growth, and this is all on the back of APRA's clamp down on investors as well as interest-only investors.
And do you think, obviously we've got our long-awaited Royal Commission hanging in the air at the moment. Do you think that there's going to be a bit of a look into lending standards, and certainly that's been a topic that's come out in the papers in the last sort of few weeks, that things are going to need to be done. Big question over the distribution methods of loans as well. Potentially a headwind for loan growth?
Oh, absolutely. There's several headwinds which are going to affect the property market the next couple of years. First of all, we're currently seeing bank funding costs rise. Now, whether this is maintained is another matter, but assuming it is, that'll flow into higher mortgage rates, other things equal. The next chart here shows that we're facing a bit of an interest-only time bomb. So APRA has clamped down on interest-only lending, and basically there's a whole bunch of interest-only loans that are currently present, which are due to expire in the next few years, because they're basically done on a 5-year basis. So at the end of 5 years, you've got to either refinance into another interest-only loan, or you've got to take out a principal and interest loan. And under the new rules, they won't be allowed to rotate into another interest-only loan, so they're going to become principal and interest. And according to UBS, and this is what the chart shows, we're expecting $105 billion worth of loans interest-only loans to rollover in 2018, and then another 133 billion in 2019, and then another 159 billion in 2020.
Wow.
And all these loans are expected, because they won't be able to roll over an interest-only loan, they have to go to principal and interest, that they could face between a 35 to 50% increase in mortgage repayments. So that's quite a significant headwind. It could lead to some sellers having some homeowners having to sell because they can't afford to keep up interest payments. And obviously will also affect new home growth because investors which would have taken out interest-only loans can't anymore. So that's a bit of a headwind. On top of that, we've also got Labor's negative gearing and capital gains tax reforms, which will likely come into effect on 1 July next year, assuming they get elected, which is looking more and more likely. So that's going to also smack the investor market. And then finally, just as Tim mentioned, we've got all the fallout from the Banking Royal Commission, which we don't know how it's going to play out, but it's currently not looking good. And I wouldn't be surprised if we were going to get a tightening mortgage market, tightening lending standards, and also some crackdown from regulatory action. So, I'm not that. I can certainly see some pretty stiff headwinds for the housing market in the next couple of years. Of course, against that, we've got ongoing, very strong population growth, which, if continues, should put a floor under it a bit. But these are all strong headwinds, which could also obviously run headfirst into a global shock in the next few years, which will make everything worse. So I'm a little bit concerned about the housing market.
Okay. Fair words, mate. Fair words. Okay, so look, we'll roll into an overall summation and outlook of our OzEconomics webinar today. So if you'd like, maybe just give us a bit of top level there. I've jotted a few dot points down for you, Lee. So if you want to, we can drag our way through those.
Yeah, well, as that domestic final demand chart, which is probably the key chart, really showed, currently growth's been driven by household consumption, government spending, and what was the other one? I can't remember. So anyway, household consumption, government spending, and something else which I've just forgotten at the moment. But anyway,
population Ponzi.
That's right. Anyway, the overall outlook's pretty soft. I mean, I'm certainly not expecting a imminent recession or anything like that, but just more of the same, more of a grinding out of growth in aggregate basis, and very weak growth in per capita terms. Basically, continuation of sort of per capita almost recession we've had for the past 5-6 years. There is another fly in the ointment, and this is more, I'm speaking more on Dave's side, but commodity price, we're expecting commodity prices in terms of trade to fall from the second half this year. And if that happens, that's obviously going to drag down company profits, national income and tax receipts, which will weigh on the economy through various different mechanisms. Consumption, again, the biggest driver of growth, which is 56%, we're expecting to remain weak on the back of still anemic wages growth, high household debt, and of course falling dwelling prices. And then on top of that, the dwelling construction boom is going to continue to unwind, which again will drag down on jobs and growth. And the infrastructure pipeline will support growth for the next couple of years, but its impact's going to keep falling compared to the last couple of years. And it will eventually peak by about 2020, and that'll start dragging down on jobs and growth. So overall, it's probably more of the same, pretty weak aggregate growth like we've had the last couple of years, and very weak per capita growth. And this sets us up in a pretty precarious position if should another global shock hit us in the face.
Okay, very good. And if we might now pivot from an economic standpoint to an investment standpoint, I'll call on Damien to, I guess, give us some reflections on the topics and themes and certainly the data that we've seen today, and then how that reflects in what we do every day at Nucleus Wealth.
Yeah, as Leith said, it looks like the best of it's behind us at the moment. I think we've been through a record mining boom and followed by a record housing boom, and both of those are coming off, and so the question for us is very much whether we're interested in being in Australia at all, or whether there's other markets where, whether it be cash bonds or international assets, where we think we can actually get better returns. The growth profile looks a bit better, and and the risks are a bit lower. And so that's largely our take is that we're sort of running it close to our minimum levels for Aussie assets within our funds, Aussie shares. So I guess the biggest thing there's two ways about saying this. One is we're expressing to say, look, we think that at the tail end of the boom is not, and with relatively elevated prices and commodity prices rolling off and all those effects, is now's not the time to be investing in Australian shares, and that you can get a better return elsewhere. The question then is saying, well, we still own some Australian assets, and that sort of investment mandate are designed to make sure you're not taking too much risk on one or the one side or the other, and there is obviously an effect of people have got most people living in Australia are going to have Australian dollar liabilities, and so they want to make sure they've got Australian dollar assets to offset those.
Sure.
And so within Australia, we've been looking very much at companies that will benefit from a lower dollar. Now, sometimes that means companies that have overseas operations, whether it be and sell overseas, whether it be things like CSL and Cochlear, that sort of global businesses, headquartered in Australia, but largely selling right around the world.
Yep.
Or whether it be something like a Treasury Wine, which is an exporter, and so they've got Australian dollar costs, and they're making US dollar or euro revenues. And so as the Aussie dollar falls,
they get a free discount.
Their costs stay the same, and their revenues go up. So,
Sure.
So they're the ones we've been pushing for a number of years now. The real problem in that sector is they're just getting so expensive. Is that they've been fantastic performers for 3, 4, 5 years, well, probably even longer, and the markets have sort of pushed the valuations you can in that sector. And so what we're tending to find is we're starting to take a little bit off the top, and some of those, just over the last few weeks, we've sort of sold down a little bit just because there's a price for everything. So, at 10 times earnings, we'd be happy to own, that whole entire sector.
Yep.
At 100 times earnings, we wouldn't. And we're sort of, we're at 30 times for a lot of the stocks, and it's just to the point where, as much as we like them and they've been great performers in the portfolio, it's just a matter of trying to find exposures that can give us something similar, but without having to pay too much for it.
Well, it has been a pretty well-trodden path, hasn't it? The dollar exposed. We've been reading about it for many years. So,
and we do think there's scope. So the dollars keep falling, and these guys' the profits keep growing, and so there is still scope there, but it's just a matter of getting the right price for it.
Sure.
The big parts of the Australian economy, banks, resources, property, all sort of fit into the Leith's narrative as being relatively negative on all of those. The banks is actually the opposite story to the dollar exposed, in that they're on sale at the moment. Everyone's pricing in a lot of negativity, and so your yields you're getting close to a 7% yield on them, assuming the dividend doesn't get cut.
That's right.
That's a big important factor.
Yep.
But they're certainly trading at usually they trade at sort of a 10% discount to the market. Now they're trading at sort of closer to a 20% discount to the market.
Wow.
So they are on sale. There are some difficult headwinds, so you're sort of looking at exactly the opposite. You can pick them up cheaply, but the fundamentals aren't looking particularly strong. And so is now the time to try and clear out of that sector completely? We think that we've still got an exposure. We're certainly underweight, but there will be a time where, or hopefully there won't be, but we're expecting a time when a lot of these will start to roll over, and whether it be the next global shock and we see house prices come back and things like that, and you'll be looking to try and clear out completely. But if you're getting a 7% fully franked yield, you're getting close to 10%. That's better than what you can get on most utilities. And so it's more just trying to work out how much downside is in the price.
Yeah, and the earnings releases over the next few years, given the Royal Commission, are going to be fantastically watched, I think. Everyone's going to want to see how it's the impact.
But you could knock 20% off earnings of these guys and 20% off dividends and still be relatively happy with if you came out the other side of a crisis, with that type of thing, or if we managed a relatively smooth transition and earnings fell by 20% and you could pick them up at today's prices and pick them up a little bit cheaper, I'm sure, as things go on. But your net return after that you wouldn't be too disappointed with. The issue obviously is there's a tail risk to global shock. Australia's run out of ammunition and
running out of booms.
That's right. Need to find another boom to invest in, and we're not quite sure what that is.
Yep.
Maybe it's an infrastructure and healthcare boom, but there's obviously a limit to how far they can push as well.
Well, and the other side of that is that they're not sort of money generating booms; they're sort of services booms. They give you potentially they give you productivity in an infrastructure sense, and they give you lifestyle and longevity perhaps in a healthcare sense, but there's no cash benefit really at the other end. There's no paid dirt, is there?
Well, I think they. Well, I'd probably argue a little bit. That improving the health improves the economic outcome for people work longer and things like that. So there's benefits. There's certainly. Yeah. I wouldn't downplay it, but it's less.
Cut and dried from a profit point of view. Perhaps.
Yeah, that's right. And as we spoke, a lot of the things that are being put in have got the potential for the middlemen to step in and grab 60, 70, 80% of the benefit that's ending up flowing from having somebody's got a problem, somebody's going to fix that problem. That's great. That actually, the NDIS was showing that it's actually a net positive for society if you spend the money and you get rid of all these issues and all that type of stuff.
It makes sense until the middlemen, as you say.
Exactly. The issue
erode
is
the value.
if the middlemen then jump in and take it. And so, I've got an anecdote I tell in the telecommunications sector, which is a similar type of thing where we were trying to get some cables put in for telecommunications, and we're dealing subcontractors, and we worked out that we're actually dealing 7 subcontractors deep from the actual person who was, we're dealing with, I think, IONET, and then Telstra, and then Telstra had outsourced and bang all the way down.
Yeah, wow.
And so the guy on the tail end of it, which is great in terms of, people are going, oh, it's very efficient and all that type of stuff, but there's a margin a ticket being clipped every single step of the way. And so, yeah, I think if you end up with those types of issues, and it looks like, that certainly happened in the education sector, and it's hard to think of a reason why it won't happen in the healthcare sector as well.
Absolutely, and so we were talking before about running out of booms. So just a quick, just your thoughts on the resources side as well. We've got obviously banks and property are fairly aligned, but from a resources standpoint.
So the resources, a big issue there is China, and it's slowing. And the question is, can China keep going at current rates and keep racking up the debt? Yeah, sure it can. But that's an accelerate into at least keep your speed as you're headed for an eventual brick wall. We do think they're trying to slow down, and all the stats and lending stats are showing that they are trying to slow down, and that's not good for resources generally. There are some scenarios where you can paint that you get a deal with between China and Trump. You get renewed spending, and you get a worldwide global synchronized boom, and that would be great for resources. And so that's sort of we think of that as a tail event, though. It's not really a risk, but that's your tail upside. Whereas the bulk of the probability is more on the downside, that you do get China starting to transition away. Yes, Trump's got a boom going on, but a lot of that's not going to be resources driven, and it's more sort of in services sectors and things like that. And so, and for Australia anyway, the iron ore that's in Brazil is a lot closer to the US than Australia. So, than Australian iron ore is, and so that's sort of the benefits flow elsewhere. On the property side, it's a little bit. There's two sides to it. Is that, as we spoke about, if population keeps coming in, then if you're building property, you still need to have that property. So it still needs to be built for the people that are coming in. And also that if you own property and we've got this huge influx of people wanting to come in, then and we keep our limits on expansion and try and cram everyone into the same space, and you just get this supply-demand thing that helps hold the value there. My side, though, is that, given the valuations and it's not as... there's other sectors I'd prefer to seek defensiveness. Property is generally a defensive sector. Mm-hmm. I guess the issues I have is that if you're buying it for defensive qualities at this point, you have a tail event which could wipe out all your defensive qualities.
Yep,
and so,
sure.
I'm looking for defensive qualities in other sectors. What does that leave? Well, it's as I said, it's extremely tough in Australia that we've wiped out dollar. We've sort of hit our limit on dollar exposed. banks, resources, property are all, for various reasons have got issues, and that basically means anything else that's, got a heartbeat and not incredibly, not sort of poor quality and not or not incredibly overvalued is sort of ends up in the portfolio.
Okay.
But it is sort of certainly a very difficult part, which is why for now we're finding that either cash, bonds, or international assets we can see opportunities and we can see upside, whereas it is very difficult.
And I guess that's the beauty of having access to world markets, because you're not just corralled into the ASX, which for those three key reasons you put there, are the bulk of the top end of the investable market in the ASX.
And actually, just to tail off the final comment I did want to make in terms of booms, what's the boom that's going to what is our next boom? I think for our perspective, the next boom is manufacturing, services,
Wow.
education, all these things like that, which all need a lower Aussie dollar to get you there. It's what you need is they're the only sectors that are big enough to actually make a dent in terms of the taking away the capex that's gone and the housing boom that's over and those types of things. Is we need these sectors that are actually basically need a lower Australian dollar to get there. And so the real play is, yes, we want to be investing in the Australian market at points in the cycle. Now's not the point in the cycle. We're lining up which ones we want, and as the Aussie dollar comes down, you'd just be switching international assets for Aussie assets.
Sure. Okay. Fantastic. Lovely. Thanks for that summation on what we're doing at Nucleus Wealth there, Damien. And thanks very much, gents, for coming along. Thanks, Leith.
No worries.
And thank you, Damien, for another terrific webinar. So just stand by now. We've got, for those that are interested in finding out a little bit more of what we do every day at Nucleus Wealth, we'll jump into that now, and I'll see you on the other side.
Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to these everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency in what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio, which is managed by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for cash management, and JP Morgan, one of the biggest banks in the world, as custodian of your assets. We feel that this structure is the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating the areas that are only important to you, you keep the potential for higher returning areas that you might otherwise be ambivalent about, and these would typically be ruled out in broader ethical products currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they may have experience in. We also offer a complete investment solution for those who don't have time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that typically sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com.
Okay. So on that note, I thought we'd just feed into our next promo for our next one. So it's same bat time, same bat channel on the 12th of April at 12:30. And then we've entitled it Nucleus Insights, the World Valuation Roundup, where we'll be running the ruler over our global equities prices and I guess different measures that we're looking at evaluating against long-term averages, and then of course where we're headed, and a bit of a focus I guess given the fact that we as we mentioned we're pretty underweight Aussie at the moment, so the jewel in the crown is to find the value overseas. So feel free to log in proton.nucleuswealth.com to register your interest for that one, and we'll catch you there. And just finally, as always, we'll be sending out our little review pack, our survey, which gives you the opportunity to give us a bit of feedback on how we've gone today, and also give us some ideas for future webinars. More than happy to put together something if it's a topic that a few people are looking to hear about, and we can do a bit of research and bring it to you. So on that note, well, thank you very much for your attendance today, and we look forward to catching you at the next one. Cheers.